Hello everyone. In this video I'm going to go through the answer key for your assignment for this week regarding share repurchases and the article by Dittmar and Fields that covers some information about share repurchases and stock buybacks or share buybacks. And then I'm going to go through your shorter assignment for next week on the same topic. But let's start off with this assignment first. So out on D2L, I put the answer key. It looks like this. It says assignment 4 share repurchases. And then I ask you to read the article and answer the following questions. So the first question says, within the first three paragraphs of the article, the authors provide 3 benefits from repurchasing shares. What are they? The 3 benefits they give are that they give companies a tax-efficient way of paying out capital that cannot be profitably reinvested inside of the firm. The idea here is that firms sometimes generate cash and they don't have good reinvestment opportunities, and so the proper thing to do in that case might be to pay that back out to investors who can reallocate it to better investments. The second reason is preventing management by taking on that's incorrect. I should say preventing management from, not by, from taking on low return projects with the cash that is used to repurchase shares. In other words, again, they don't have good investment opportunities. What management might do is to take on low return projects or projects that aren't good for the firm because they've got that excess cash. So the better thing to do might be to go out and use that cash or pay that cash out to investors to reallocate it. The third benefit is that managers can increase value to remaining shareholders by repurchasing undervalued shares. And this last one, we're going to see it later on in the answers here. This is probably the most controversial one. The idea that there are companies out there and understand that most S&P 500 firms, the firms within that index, repurchase shares. The idea that so many of those companies might be undervalued is against the idea of market efficiency, goes against that idea. And so this third point is probably the most controversial one. The second question says, in the third and fourth paragraphs, there we go, of the paper, the authors discuss undervaluation and wealth transfer. According to the authors, if the stock is undervalued at the time of the buyback, who is wealth transferred from and who is it transferred to? So in this instance, value is transferred from the investors who sell back their stock to the investors who keep the stock. So the idea is that the investors that the stock is undervalued, that it's worth really more than what the price is out in the stock market. And so people that sell their undervalued shares back at that market price are losing out in potential value and income and wealth gain because they're giving up something for less than what it's truly worth. If the stock is correctly valued, or fully valued per the authors, who is wealth transferred from and who is it transferred to? If the stocks are correctly valued, then there's no wealth transfer. If a stock is correctly valued at $100 and the company pays $100 for that stock, the company is getting something worth $100 for $100. So there's no transfer of wealth, there's just a transfer of cash from the company to the investor. If the stock is overvalued, okay, this last part of the question, if it's selling for more than it's worth at the time of the buyback, who is the wealth transferred from? It's transferred from the company and ultimately its remaining stockholders to those who sell back their stock, because they're selling their stock back to the company for more than it's worth. So they're gaining, the people who sell their stock are gaining wealth. The people who buy the stock, the company, and ultimately its remaining shareholders, are losing wealth. So you're going to read some articles for the assignment for next week, and keep in mind as you read these articles, you're going to see in these articles that companies have repurchased a lot of shares in the last year, and in the last 10 years they've repurchased a ton of shares. With the drop in the stock market values, a lot of people might see that as wealth being transferred from the people who sold their shares back before this all happened. Let me make sure I said that right. is wealth being transferred to the people who sold their shares worth back before this all happened from the companies and their stockholders, because the company bought shares at a high price and then the price dropped, and so those shares aren't worth as much as they were when they were purchased by the company. Question 3 says Figure 1 on page 74. So I'm going to go there. Figure 1 on page 74 right here. Shows a significant drop in the number of shares of firms repurchasing shares between 2008 and 2009. What caused the number of firms that were repurchasing to decline so much in 2009? So the answer is not in the paper. Consider what events were occurring at the time. The economic recession, the financial crisis, reduced the number of firms that were repurchasing. This was due to a decrease in cash available by businesses to use to repurchase stock. So there was a liquidity crisis, meaning there was a drop in the amount of cash available through banks, because a lot of banks at this time were getting shut down. A lot of their loans were going bad, and so they couldn't lend out much money as a result of that going on. And so this decreased the amount of cash available to businesses, because sometimes companies take out loans in order to repurchase their shares. We've taken a look at this a little bit before when we looked at Pepsi. Pepsi's done this. Coca-Cola certainly has done this. Actually, a lot of businesses have done this, where they've taken out loans or issued bonds and then used that cash to repurchase shares. With an inability for banks to lend out money, some of the cash dried up for stock repurchases. And we certainly, again, we saw this in 2008 and 2009. According to the information on pages 75 and 76, how were frequent repurchasers different from infrequent repurchasers? And so this is, to me, the main point of this paper. It's the idea that we separate out repurchasers from those companies that repurchase frequently and those that don't repurchase frequently. So infrequent repurchasers repurchase between 1 and 4 times per year. So they go out to the market between 1 and 4 times per year, while frequent repurchasers repurchase more than 9 times per year. So what do we know about the difference between those two groups? Frequent repurchases were larger and more profitable than infrequent repurchasers. Frequent repurchasers had higher market-to-book and dividend payout ratios, and frequent repurchasers had a lower bid-ask spread and lower stock return volatility. So we have the idea here that frequent repurchasers are probably larger, more stable companies. The idea that they have higher dividend payout ratios kind of indicates that they're more mature. They're longer along in their life cycle, where their ability to find good investments has maybe gone down a little bit, and so now they're paying out more cash through repurchasing stock more often and paying out more in dividends. Number 5, beginning on page 77, the authors provide evidence as to whether managers do a good job of timing the market in order to repurchase shares when they are undervalued. According to the authors, in general, are managers able to time the market in order to repurchase shares when they're undervalued? And then secondly, what evidence do the authors provide? So according to the authors, managers in general are able to time the market in order to repurchase shares when they're undervalued. For the entire sample, companies repurchase their shares at a median 0.88% discount, which may not sound like a lot, but it's actually quite a bit in terms of an annual return for a stock. They're getting a discount to the average price for the discount month. So they are able to time the market some and get prices, stocks at a lower price than average. In the same section of the paper, the authors provide information on the success of frequent and infrequent repurchasers at repurchasing shares when they are undervalued. Which group does a better job? Infrequent repurchasers are better at timing share repurchases than the frequent repurchasers. Number 7 says, on page 79, the authors discuss whether the stated reason for the repurchase program matters. When firms make repurchase announcements, managers can provide the motivation for the repurchase program in the announcement. The author separated announcements based on whether the firm statement provided undervaluation as a motivation for the repurchase program. So let me stop there and say that that may not be the best indicator, but the authors had to choose something, or wanted to choose something, to separate the motivation for the stock repurchase. Most firms, when they repurchase stock, want the market and want investors to believe that they are repurchasing because the stock is undervalued. So did providing undervaluation as a motivation affect the stock returns at the time of the announcement? If undervaluation was cited as a motivation, then the cumulative abnormal return, and that's explained in the article surrounding the announcement, was 0.42% higher than if it wasn't cited as a motivation. The difference in CARs is statistically significant. In other words, it did have an effect, a positive effect, on the return surrounding the announcement. The next part of this question: were the relative repurchase prices different between firms that provided undervaluation as a motivation and those that didn't? The difference was slight and not statistically significant. So there was a difference, but it wasn't large enough to statistically be a difference between those that did and those that did not cite undervaluation. The next question talks about a table with the results of a multivariate regression. So I'm going to go to that table. So that's table 3. Here we go. So this is table 3. It shows the regressions of the relative repurchase price on firm and repurchasing characteristics. The relative repurchase price is measured as the percentage difference between the average repurchase price paid by the firm during a repurchase month and the average closing stock prices as reported on CRSP during the various windows. So in other words, for this first regression here, we're looking at the average closing prices for the repurchase month plus 1 month, the average repurchase prices for the second column for the repurchase month plus 3 months, and then the average for 6 months after the repurchase month, to see if firms are in fact repurchasing at a discount when the stock is undervalued. In other words, do they do a good time at picking the right time to repurchase stocks when they're going to benefit their remaining stockholders the most? Okay. So what we see here and what's in the answer to the assignment here is that infrequent repurchasers are able to do that. Their relative repurchase price is negatively related to being an infrequent repurchaser. In other words, they're buying it for less. They're buying an undervalued stock. And that is statistically significant at, I believe, the 1% level. Yeah, right here, 1% level. That's with the 3 asterisks here. And so infrequent repurchasers, according to this regression here, are able to time their picks in order to buy shares when they're undervalued and provide a greater return, hopefully, to the stockholders that don't sell their shares back. So in the first question, or in the first couple of questions, when we talked about wealth transfer, in this case, the infrequent repurchasing firms are transferring wealth from the stockholders who sell their stock back to them, to the stockholders who remain with the firm. So To the answer to this question 8, based on the results, infrequent repurchasers are successful in repurchasing shares when they are undervalued. In general, are moderate repurchasers successful in repurchasing shares when they are undervalued? Moderate repurchasers are successful in repurchase shares when they are undervalued based on the negative and statistically significant coefficient on the intercept. So we have 3 kinds of repurchasers: frequent, moderate, and infrequent. The intercept reflects the outcome for the moderate repurchasers too. Question 9. According to the results provided in Table 3, which other variables are important in determining whether shares are purchased at a discount or at a premium at the time of the repurchase? Note that the coefficient for the variable should be statistically significant in order to indicate that it has an impact on the resulting RRP. So the other statistically significant variables are the size of the firm and assets, stock return volatility, prior 6-month return, the number of analysts is slightly significant, change in 6-month EPS forecast, and the prior 6-month abnormal return for the stock. So I'm just going to take a look at one of these. The number of analysts, we can see is slightly for 1 month. Go out 3 and 6 months, and it's not. And it's honestly a little surprising that this one here is really even statistically significant, because the idea is that the number of analysts that a firm has, the least likely for that firm to be under or overvalued, because the market should be more efficient for these firms that have more analysts covering them. Let's move on here to question 10. Table 4 provides the result of the Fama-French regressions for the returns for frequent and infrequent repurchasers for periods ranging from 3 months to 3 years following the share repurchase. Fama and French determined that 3 different risks are significant in explaining the returns provided for stocks. The 3 risks are the market risk, the size risk, and the value risk. These are referenced in the table as RMRF, which is the return for the market minus the risk-free rate, and that's going to be the market risk. SMB stands for small minus big, so that's the size risk, and high minus low is the value risk. So it's high book-to-market value minus low book-to-market value. Statistically significant intercepts indicate that the investment is providing an excess return not explained by the risk of the investment if the intercept is positive, or is underperforming and not sufficiently rewarding investors for the investment's risk if the intercept is negative. Sorry about that. There we go. Based on the results in Table 4, do firms that repurchase shares during the sample period provide excess returns to stockholders? Which type of repurchasers provided the highest excess returns to shareholders, infrequent or frequent repurchasers? So let's go to Table 4. Here it is. And the answer is, there we go. Based on the Fama-French results, firms that repurchase shares during the sample period provide excess returns to stockholders. Infrequent repurchasers provided the highest excess return to stockholders. So I'm looking out here, I'm looking to see if the firms that repurchase shares provided a higher return to their shareholders, this intercept should be positive and statistically significant. And it is positive and statistically significant. It might look low, but the thing to realize here is that this is a monthly return. You can annualize this. I explain how to in the answer. But you can annualize these numbers to see what the annualized excess return is. And then it breaks it. It's got it broken down: infrequent, frequent, and then frequent minus infrequent, to see that the infrequent repurchasers have the highest, consistently the highest excess return. So again, the infrequent repurchasers seem to do a better job of timing the market and finding the undervalued firms. or sorry, not firms, but the times when their firms are undervalued. All right, so that kind of finishes up the answers to that. Let me know if you have any questions about that. I'm going to move on now to your kind of follow-up assignment for this week with share repurchases. So I'm going to first start over here on the content. If you scroll down to distributions to shareholders, follow-up articles. So share buybacks and stock repurchases have been in the news a lot lately. If you've been paying attention to the business news and the coronavirus stimulus plans, there have been parts of those plans have been included to restrict firms who are receiving bailouts from buying back their shares for a certain period of time. One of these articles talks a little bit about that and saying that the plan calls for the entire time they're receiving aid plus 1 year. So that may have changed in the final result, but certainly there are restrictions on repurchasing shares by firms who are receiving money from the government. So I've got 3 different Wall Street Journal articles here. They're in order of when they were published. So this first one here was published March 25th. The second one was that's not right. The first one was published, I'll just pull it up, March 17th. The second one was published March 25th. The last one was published on April 5th. So just, I'm recording this on April 6th, so just yesterday this one was published. So they kind of give a points of view on repurchasing shares and the limitations on repurchasing shares and what companies are currently doing regarding share repurchases. This second one is a politics article. I get the impression that there is certainly some opinion included in this article. There are certain phrases such as Democrats and liberal activists that kind of give me an idea that we're getting someone's point of view. However, I feel the point of view in this article is pretty balanced. So it's not overboard. For these articles, I put out a 10-point quiz for your 10 follow-up points or group work points. It's out under the assessments and quizzes. And I apologize, my screen maybe looks a little different than yours. So there's a share repurchase articles quiz at the beginning of each question. There, I refer to which article the question is for, so you'll know as you're answering that question. There is, I believe, unlimited time, so it's not a rush. You don't have to go through and try to read and memorize the articles before taking the quiz. It is due by 5:30 p.m. on next Monday, so essentially the time the class would normally start when this quiz is due. Please let me know if you have a difficult time accessing the quiz or if there's any problems with that. That's really it for this week. What we're going to do going forward is next week I'll put out a longer lecture on capital structure and give you an assignment based on that. And then, the following week is kind of, again, a follow-up week. I'll probably, though, include some additional lecture in that week because the last topic we cover is on firm valuation, and that's kind of a longer topic. It takes a little more time. So, and then the week after that, you'll have an assignment due. And then the following week is going to be your final exam week. So, the final exam will be similar to what the one you took for your midterm. Open note, open D2L website, and let me know if you have any questions or if there's anything going on that might inhibit you from getting things turned in on time or really accessing any of the information for the class. I'm happy to work with you on that. So I hope you're staying well and staying safe, and I will talk to you again later.